Good day, everyone. We are Group 5, and today we are assigned requests to discuss about the Chapter 7, which are all about the points and valuation. But first, let me introduce ourselves. So, hi, I am Miss Jana Maxine Hordana. Together with me is Miss Colleen Manala, and we are from 3.1 PSPA FM. So, as we begin, let us start with our overview. So after our discussion or reporting, you guys will be able to determine what bonds are and who issued this, as well as the key characteristic of bonds. You will also know the bond valuation, bond yield, bond with semi-annual coupons, and of course to assess the risk of bonds. And you will also determine and know the default rate. And last but not the least is the bond market. So now let us determine what is bond. Bonds are the most important securities. It is a long-term debt instrument under which a borrower agrees to make payments of interest and principal on specific dates to the holder of the bond. So as we now know what is bond, let us now determine who issued this.
So, who issues the bonds? Until the 1970s, most bonds were beautifully engraved piece of paper and their key of terms, including their face value, were spelled out on the bonds themselves. Today, though virtually all bonds are represented by electronic data stored in secure computers, much like the money in a bank checking account. For example, on January 3, 2006, Alice Food Products borrowed $50 million by issuing $50 million of bonds. For convenience, we assume that Alice sold 50,000 individual bonds for $1,000 each. Actually, it could have sold one $50 million bond, 10 bonds each with a 5 million face value, or any other combination that totals to $50 million. In any event, Alice received the $15 million, and in exchange, it promised to make annual interest payments and to repay the $50 million on a specific maturity date. Investors have many choices when investing in bonds, but bonds are classified into four main types or categories: the treasury, the corporate, municipal, and the foreign. Each differs with respect to risk and consequently to its expected return. So for the first one, we have the treasury bonds. It is generally called the treasuries, and sometimes it is referred to as government bonds. Why? Because these are issued by the federal government. It is reasonable to assume that the federal government will make goods on its promised payments, so treasuries have no default risk. However, these bonds prices decline when interest rates rise, so they are not really completely risk-free. The second one is the corporate bonds. As the name implies, are issued by corporations. Unlike treasuries, corporate bonds are exposed to default risk. If the issuing company gets into trouble, it may be unable to make the promised interest and principal payments. Different corporate bonds have different level of default risk, depending on the issuing company's characteristics and on the terms of the specific bond. Default risk is often referred to as credit risk. And as we all know, the larger the default risk, the higher the interest rate investors demand. The next one is the municipal bonds or munis. It is issued by the state and local governments. Like the corporates, munis are exposed to default risk. However, munis offer one major advantage over all over bonds. The interest earned on the munis is exempt from federal taxes and also from state taxes if the holder is a resident of the issuing state. Consequently, the interest rates of munis are considerably lower than on corporates of equivalent risk. And for the fourth and last one, we have the foreign bonds. It is issued by government or foreign governments or foreign corporations. Foreign corporations' bonds are of course exposed to default risk as the others, and so are the bonds of some foreign governments. And additional risk exists if the bonds are denominated in a currency other than that of the investor's home currency. Take note of that. For example, if you purchase a corporate bond denominated in Japanese yen, even if the company does not default, you still use the you still lose the money if the Japanese yen falls relatively to the dollar. So now, we're going to discuss the key characteristics of bonds. Although all bonds have some common characteristics, different bonds also have some different contractual features. For example, most corporate bonds have provisions for early repayments, call features, but the specific call provisions can vary widely among different bonds. Similarly, some bonds are backed up by specific assets that must be turned over to the bondholders if the issuer defaults, while the other bonds have no such collateral backup. Differences in contractual provisions and in fundamental underlying financial strength of the companies backing the bonds lead to differences in bonds risk, prices, and expected returns. To understand the bonds, it is essential that you understand the following terms. The first one is par value. For the par value, it is stated face value of the bond. For illustrative purposes, we generally assume a par value of $1,000, although any multiple of $1,000, for example, $5,000 or $5 million, can be used. The par value generally represents the amount of money the firm borrows and promises to repay on the maturity date.
Coupon interest rates. It is the periodic rate of interest paid by bond issuers to its purchaser. The coupon rate is calculated on the bond's face value or par value that we call, not on the issue price or market price. For example, Alice bonds have a $1,000 par value and they pay $100 in interest each year. So the bond's coupon payment is $100, so its coupon interest rate is 10 because $100 divided by $1,000 equals to 10%. So under coupon interest rates, we have first the coupon payment, where it is the specified number of dollars of interest paid each year. Second is the floating rate bond. It is a bond whose interest rate fluctuates with shifts in the general level of interest rate. The third one is zero coupon bond, where it is a bond that pays no annual interest but is sold at a discount below par, thus providing compensation to investors in the form of capital appreciation. And the last one is the OID, or Original Issue Discount Bond. It is any bond originally offered at a price below its par value.
The next one is maturity date. Bonds generally have a specific maturity date on which the par value must be repaid. Alice bonds, which were issued on January 3, 2006, will mature on January 2, 2001. Thus, they had a 15-year maturity at the time they were issued. Most of the bonds have maturities. The maturity at the time of the bond is issued ranging from 10 years to 40 years, but any maturity is legally permissible. Of course, the effective maturity of a bond declines each year after it has been issued. Thus, Alice bonds had a 15-year originally maturity, but in 2007, a year later, they will have a 14-year maturity and so on.
Call for provision. So this is where most corporate and municipal bonds, but not the treasury bonds, contain a call for provision, which gives the issuer the right to call the bonds for redemption. This is also generally states that the issuer must pay the bondholders an amount greater than the par value if they call. The additional sum, which is termed a call premium, is often set equals to 1 year's interest. So, for example, the call premium on a 10-year bond with a 10% annual coupon and a par value of $1,000 would be $100, which means that the issuer would have to pay investor $1,100, which is the par value plus the call premium, if they wanted to call the bonds. In most cases, the provisions in the bond contract are set so that the call premium declines over time as the bonds approach maturity. Also, while the bonds are immediately callable, so callable means redeemable bonds, it can be redeemed or paid by the issuer prior to the bond's maturity date. In most cases, bonds are often not callable until several years, generally 5 to 10 years after issue. This is known as the deferred call, and the bonds are said to have call protection.
The next one is the sinking funds. Some bonds also include a sinking fund provision that facilitates the orderly retirement of the bond issue. Years ago, firms were required to deposit money with a trustee which invested the funds and then used the accumulated sum to retire the bonds when they mature. Today, though sinking funds provision require the issuer to buy back a specific percentage of the issue each year. A failure to meet the sinking fund requirement constitutes a default, which may throw the company into bankruptcy. Therefore, a sinking fund puts a significant cash drain on the firm. In most cases, the issuer can handle the sinking funds in either of two ways. The first one is the company can call in for redemption at par value a certain percentage of the bonds each year. For example, it might call 5% of the total original amount of the issue at the price of $1,000 per bond. The bonds are numbered serially, and those called for redemption are determined by a lottery administered by the trustee. The second one, alternatively, the company can buy the required bonds on an open market. The firm will choose the least cost method. If interest rate have risen since the bonds was issued, then the bonds will sell at a price below its par value. So the firm will buy bonds in the open market at a discount. On the other hand, if interest rates have fallen and the bond's price has risen above par value, it will use the call option. Note that a call for sinking fund purposes is quite different from a refunding call. A sinking fund call requires no call premium, but only a small percentage of the issue is normally callable in a given year. Although sinking funds are designed to protect investors by ensuring that the bonds are retired in an orderly fashion, you should recognize that sinking funds can work to the detriment of bondholders. For example, suppose the bonds carries a 10% interest rate, but yields on similar bonds have fallen to 7.5%. A sinking fund call at par would require a long-term investor to give up a bond that pays $100 of interest and then to reinvest in a bond that pays only $75 per year. This is an obvious disadvantage to those bondholders whose bonds are called. On balance, however, bonds that have a sinking fund are regarded as being safer than those without such a provision. So, at the time they are issued, sinking fund bonds have lower coupon rates than otherwise similar bonds without sinking funds. So, for the other features, several other types of bonds are used sufficiently often to warrant mention. First, convertible bonds. It is bonds that are exchangeable into share of common stock at a fixed price at the option of a bondholder. Convertibles have lower coupon rates than non-convertible debt with similar credit risk, but they offer investors the chance for capital gains as compensation for the lower coupon rate. Bonds issued with warrants are similar to convertibles. This is the second one. Warrants are options that permit the holder to buy stock for the stated price, thereby providing a capital gain if the stock's price rises. Bonds with issued Bonds issued with warrants like convertibles carry lower coupon rates than regular bonds. Unlike callable bonds that give the issuer the option to buy back their debt prior to maturity, the third bond is the putable bond allows investor to sell the bonds back to the company prior to maturity at a specific date or specific price. If interest rates rise, the investors will put these bonds back to the company and reinvest in higher coupon bonds. Another variation is the income bond, which pays interest only if the interest is earned. Thus, income bonds cannot bankrupt a company, but from an investor standpoint, they are riskier than regular bonds. Yet another band is the index or purchasing power band. The interest rate is based on the inflation index such as the consumer price index, so the interest paid rises automatically when the inflation rate rises, thus protecting holders against inflation. The US Treasury is the main issuer of the index bonds.
Bond valuation. So it is a technique for determining the theoretical fair value of a particular bond. It is the value of any financial asset, a stock, a bond, a lease, or even physical asset, is simply the present value of the cash flows the asset is expected to produce. So you can see here is the timeline that we have and the terms for the equation, where an RD is the bond's market rate of interest. This is the discount rate used to calculate the present value of the bond's cash flows, which is also its price. Second is the N. It is equals to the number of years before the bond matures. So we also have the INC, which is the dollar of interest paid each year. This is coupon rate multiplied by par value. It is also equal to PMT, which is the periodic interest payment. This one is par value multiplied by coupon bond. And of course, we have the M. It is the par or maturity value of the fund. This amount must be paid at maturity. So next we have our example. Alice Food Products has an annuity of $100 per year for 15 years. Discounted at 10%, then it finds the PV or the present value of the $1,000 maturity payment. So now we are going to fill in the timeline that we have earlier. So as you can see, the RT or rate discount that we have is 10%. That's why we put the 10%. Then next one is the number of years before the bonds mature, or the N, we have 15. That's why we put 15. And for INT or interest paid each year, or it is also equals to PMT, the periodic interest payment, where we have $100. That's why we put 100. And for maturity or future value, we have $1,000. That's why we put $1,000. So to compute the present value, we have here our equation where you can see an annual computation. So bond value equals to INC, which is $100 divided by 1 plus rate discount, which is the 10% raised to 1. Since I said earlier, it is computed annually. So we are going to have $100 divided by 1.1 is equals to 90.909099 or $90.91. As you can see, we get the payment in January 3, 2010, then continue to do it until the number of the year before the maturity. After that, for the maturity, we have M is equals to $1,000 divided by 1 plus rate discount, which is the 10%, and raised to the number of years before the unmature, which is the 15. So we are going to have $1,000 divided by 4.17724869 is equals to 239.3920 or 94 or $239.39. So as you can see, we get the payment in January 2, 2021. And remember, do not round off when still calculating because you will not get the right answer. But if you already done with the final answer, you can round off. So for us to get the present value, all we need to do is to add all the payments made yearly and we will going to have the present value of $1,000. However, since this is so time consuming, we have a shortcut. So in this slide, we will be using Excel where we will input all the given data for us to get the output. We just need to type equals PV, open parenthesis, RD, comma, space, and, comma, space, PNT, comma, space, MB, comma, space, type, and close parenthesis. So for the type, you can just simply input 0 or 1 or just leave it blank and then you will get the answer.
If you examine the bond market table of the Wall Street Journal or a price sheet put out by a bond dealer, you will typically see information regarding each bond's maturity date, price, and coupon interest rate. You will also see the bond's reported yield. Unlike the coupon interest rate, which is fixed, the bond's reported yield varies from day to day depending on the current market conditions. Moreover, the yield can be calculated in three different ways, and these are the bond yields. We have, as we said earlier, we have three bond yields. The first one is yield to maturity, the second one is yield to call, and the third one is the current yield. For the yield to maturity, the rate of return earned on a bond if it is held to maturity. The second one, the yield to call, the rate return earned on a bond if it is called before its maturity date. And for the third one, or the current yield, the annual interest payment on a bond divided by the bond's current price. So now we'll be discussing the yield to maturity. Suppose you were offered a 14-year, 10% annual coupon, $1,000 par value bond at a price of $1,494.93. What rate of interest would you earn on your investment if you bought the bond and held it to maturity? This is called the bonds yield to maturity or YTM. It is the interest rate generally discussed by investors when they talk about rates of return and the rate reported by the Wall Street Journal. To find the YTM, all we need to do is solve this equation in the PPT. Could substitute values for RD until we find the value that works and forces the sum of the PVs or the present values on the right side of the equation to equal $1,494.93. However, finding rate for YTM by trial and error would be a tedious time-consuming process that is, as you might guess, it is easy with a financial calculator or if we will use Excel. The yield to maturity or YTM can also be viewed as the bond's promise rate of return, which is the return that investors will receive if all the promised payments are made. However, the yield to maturity equals the expected rate of return only if first, probability of default is zero. Second, the bond cannot be called. If there is some default risk or if the bond may be called, then there is some probability that the promised payments to maturity will not be received, in which case the calculated yield to maturity will differ from the expected return. Note also that a bond yield to maturity changes whenever interest rate in the economy change, and this is almost daily, as we all know about that. An investor who purchases a bond and holds it until it matures will receive the YTM that existed on the purchase date. But the bond's calculated YTM will change frequently between the purchase date and the maturity date. So as we can see here in the PPT or the presentation, we have the N or the date. We have the 14 years. We have the present value. The PMT of is equal to 100. We have the present value. We will going to add negative in front. So we have the 1,494.93 peso. And for the future value, we have 1,000 peso. And take note that upon entering the formula in Excel, we need to type the guess and type with 0 or 1. Because we cannot proceed if we will not put the guess and the type. Upon typing it to the Excel, upon typing the formula in Excel, we will get the rate of 5%.
Yield to call. So if the current interest rates are well below an outstanding month's coupon rate, then a callable bond is likely to be called, and investors will estimate its expected rate of return as the yield to call, or which is the YTC, rather than as the yield to maturity, or the YTM. So we have here an example. It says here Alice Bonds had a provision that permitted the company, if it desired, to call them 10 years after their issue date at price of $1,100. Suppose further that interest rates had fallen, and 1 year after issuance, the going interest rate had declined, causing their price to rise to $1,494.93. To calculate the YTC or yield to call, we have this equation. However, finding RD equals to YTC by trial and error would be a time-consuming process. So it is better to solve it using Excel. See, for the number of years before the bond matures, or the N, we have 9. Then for the INP, or interest paid each year, that is also equal to PMP, periodic interest payment, we have $100. And for our PV, or present value, we have $1,494.93 minus it, since we are looking for the discount rate or interest rate per year. For our future value, or FP, we have $1,100. So for us to get the discount rate or interest rate per year, we need to type equal rate, open parenthesis, and comma, space, PMT, comma, space, PV, comma, space, FB, comma, space, type, comma, space, guess, and close parenthesis. So again, for type and guess, you can put 1 or 0 or just leave it blank. And you will get the answer for the YTC or yield to call, which is the 4.21%.
So here for the next slide, we have the changes in bond value over time. We have here the table of calculation of current yields, capital gain yields, and total returns for 7%, 10%, and 13% coupon bonds when the market rate remains constant at 10%. So here, the expected current yield is calculated as the annual interest divided by the price of the bond, while the expected capital gains yield is calculated as the difference between the end of year bond price and the beginning of year bond price divided by the beginning of year price. The expected total return is sum of the expected current yields and the expected capital gains yields. The 7% coupon bond trades at a discount, but its price must approach its par value as the maturity date approaches. At maturity, it must sell for its par value because that is the amount the company must give to its holders. So, its price must rise over time. The 13% coupon bond trades at a premium, but its price must be equal to its par value at maturity, so it must decline over time. While the prices of the 7 and 13% coupon bonds move in opposite directions, over time, each bond provides investor with the same total return. 10%, which is also the total return on the 10% coupon bond that sells at par. The discount bar has a lower coupon rate and therefore a lower current yield. But it provides a capital gain each year, as we can see here in the table. In contrast, the premium bond has a higher current yield, but it has an expected capital loss each year. So as we analyze this table, we will see the differences.
Bond with semi-annual coupons. So it is a corporate bonds that typically pay a coupon semi-annually. So we have here our equation as well as our example. And it says here, Alifood bonds pay $50 of interest each 6 months rather than $100 at the end of each year. Thus, each interest payment is only half as large, but there are twice as many of them. The coupon rate is thus stated to be 10% with semi-annual payments, when the going nominal rate of interest is RD equals to 5% with semi-annual compounding. The value of a 15-year, 10% annual coupon bond that pays $50 interest every 6 months. However, finding the present value by trial and error would be a time-consuming process, so it is better to solve it using Excel. So our N is equals to 15, and it is our annual period since we have twice as many semi-annual periods in a year. That's why we multiply this by 2, and we get the 30. So for IMT, which is also equals to PMT, we have $100, and since this is annually, we need to divide it by 2. That's why we get the $50. For FB, you will just input the given data, which is $100, which is you just copy it. And for the RD or interest per year, we have 5%. And since it is a nominal rate, we need to divide it also by 2 to get the semi-annual rate, which is 2.5%. But after inputting all the given data that we have, to get the answer, you just need to type equals to PV open parenthesis or D comma space N comma space PMP comma space FB comma space type. So again, for the type, you can just put 1 or 0 or just even leave it blank. And there you have it. You will get the answer.
So now we will be assessing a bond's riskiness. First, we have the interest rate risk. Interest rates fluctuate over time, and an increase in rates leads to a decline in the value of an outstanding bond. This risk of a decline in bond values due to an increase in interest rates is called interest rate risk. Interest rates can and do rise, as we all know of that. And rising rates cause a loss of value for bondholders. Thus, people or firms who invest in bonds are exposed to risk from increasing interest rates. Interest rate risk is higher on bonds with long maturities than on those maturing in the near future. This follows because the longer the maturity, the longer before it is paid off and the bondholder can replace it with one with higher coupon.
Reinvesting rate risk. So the risk of an income decline due to a drop in interest rate is called reinvestment rate risk. And it is obviously high on callable bonds. It is also high on short-term bonds because the shorter the bond's maturity, the fewer the years before the relatively high old coupon bonds will be replaced with the new low coupon issues. Thus, the retirees whose primary holding a short-term bonds or other debt securities will be hurt badly by a decline in rates, but holders of non-callable long-term bonds will continue to enjoy the old high rates.
And for the third one, we have comparing interest rate and reinvestment rate risk. Note that interest rate risk relates to the value of the bond portfolio, while reinvestment rate risk relates to the income the portfolio produces. If you hold long-term bonds, you will face significant interest rate risk because the value of your portfolio will decline if the rates arise. But you will not face much reinvestment rate risk because your income will be stable. On the other hand, if you hold short-term bonds, you will not be exposed to much interest rate price risk, but you will be exposed to significant reinvestment rate risk. One simple way to minimize both interest rate and reinvestment rate risk is to buy a zero coupon treasury bond with a maturity that matches the investor's investment horizon. Um, for example, assume that your investment horizon is 10 years. 10 years. If you buy a 10 year zero, you will receive a guaranteed payment in 10 years equal to the bond's face value. Hence, you face no interest rate risk. Moreover, as there are no coupon to reinvest, there is no reinvestment rate risk. This feature explains why investors with specific goals often invest in zero coupon bonds. Maturity risk premiums are generally positive. Moreover, a positive maturity risk premiums implies that investors on average regard longer term bonds as being riskier than the shorter term bonds. That, in return, suggests that the average investor is most concerned with the interest rate price risk. Still, it is appropriate for each individual investor to consider his or her situation, to recognize the risk inherent in bonds with different maturities, and to construct a portfolio that deals best with the investor's most relevant risk.
Default risk. So it is influenced by both the financial strength of the user and the term of the bond contract, including whether or not collateral has been pledged to secure the bond. So under it, we have the various types of corporate, bond rating, and bankruptcy and reorganization. So under the various types of corporate, we have first is the mortgage bond. It is a bond backed by fixed assets. First mortgage bonds are senior in priority to claims of second mortgage funds. So the second one is indenture, where it is a formal agreement between the issuer and the bondholders. The third one is the debenture. It is a long-term bond that is not secured by a mortgage on a specific property. And the last one is the subordinated debenture. It is a bond having a claim on asset only after the senior debt has been paid off in the event of liquidation.
For the second one, we have bond ratings. Since the early 90s, bonds have been assigned quality ratings that reflect their profitability of going into default. The three major rating agencies are Moody's Investor Services, Standard and Poor's Corporation or S&P, and Fitch Investor Service. Bond ratings are important both to firms and to investors. First, because a bond's rating is an indicator of its default risk. The rating has a direct, measurable influence on the bond's interest rate and the firm's cost of debt. Second, most bonds are purchased by institutional investors rather than individuals, and many institutions are restricted to investment grade securities. So here we have two bond ratings. First one in the investment grade bonds. This is a bond rated triple B or higher. Many banks and other institutional investors are permitted by law to hold only investment grade bonds. The second one is the junk bond. The only meaning here is a higher risk, a higher yield bond.
Bankruptcy and reorganization. So the decision to force a firm to liquidate versus permitting it to reorganize depends on whether the value of reorganized firm is likely to be greater than the value of its asset if they were sold piecemeal. In reorganization, the firm's creditor negotiates with management on the terms of a potential reorganization. The organization plan may call for restructuring the debt, in which case the interest may be reduced, the term to maturity length, or some of the debt may be exchanged for equity. And the point for the restructuring is to reduce the financial charges to a level that is supportable by the firm's cash flows.
So, for the last slide, we have the bond markets. Corporate bonds are traded primarily in the over-the-counter market. Most bonds are owned by and traded among large financial institutions. For example, life insurance companies, mutual funds, and pension funds, all of which deal in very large block of securities, and it is relatively easy for the over-the-counter bond dealers to arrange the transfer of large blocks of bonds among the relatively few holders of the bonds. It would be much more difficult to conduct similar operations in the stock market among the literally millions of large and small stockholders, so a higher percentage of stock trades occur on the exchanges. Information on bond trades in the over-the-counter market is not published, but a representative group of bonds is listed and traded on the bond division of the NYSE. Bond markets are where bonds are bought and sold. Bonds are essentially loans. When you buy a bond, you're lending the money to the issuer, like a government or a company, in exchange for regular interest payments and repayments of the loan amount when the bond matures. Bond markets allow investors to trade these bonds with each other, influencing their prices and yields. And that will be all for our presentation. Again, I am Colleen Manalang, together with my partner and my groupmate, Jana Maxine Aldana. We are very thankful for everyone for listening and watching. Bye-bye!